right in, and as others join them, we'll have Brooklyn admit them. So just quickly about us, we were founded in 2018. My name is Paul. This is Jason. We're going to do this together. Lots of information is going to be packed in. We do cheaper, faster, and easier home loans. We specialize with homeowners and investors. Our office is on Heights Boulevard, and we have a real cool open house partnership program. Jason, do you believe this slide to be true?
Not really,
Why not?
because knowing is only half the battle.
Do you remember this cartoon?
I do.
G.I. Joe. They always ended the same way. How's that?
Knowing is only half the battle.
What does that mean?
Means you can know things, but without doing things, then it doesn't matter.
It doesn't. So the slide's going back and forth. That's okay. So I often like to say, are you doing that, Brooklyn?
Nope, just submitting.
Perfect. So I like to say that I'm married, and knowing on Valentine's Day, and for those that aren't married, if you're dating, on Valentine's Day, you know that you have to be sweet to your spouse. But just knowing to be sweet isn't the same thing as actually being sweet, right? Like if you don't do those things, knowing doesn't matter. So our invitation to you here today is to be a good Valentine's Day sweetheart. And
I'll do my best.
good deal. So you're going to learn lots of information. Invitation is for you to actually apply this invitation in your everyday real estate life. So first question we want to start off with is, what is a hard money loan? You want to take this one away?
Sure. So a hard money loan is a loan based off of the potential value of a property. So instead of looking at the current value of the property, we look at the potential value, and you get a loan minus the cost of repairs to purchase the property.
So you just went like way down the field. It's a loan, mortgage. First lien, second lien, third lien?
First lien.
First lien. What do we expect with terms on these loans? Are we getting 6-7% interest rates with
We are
hard money
not.
loans?
Somewhere between 9 and 12.
9 and 12, 30-year loans?
No, they're interest only, 6 to 12 month loans.
So why are they designed to be short-term loans?
Because we want you to get out of the loan as quickly as possible.
And by we, the lender and the investor wants to get out
The
of it.
investor, yeah.
Right, they're paying 9, 10, 11, 12, 13, 14% interest. And that doesn't cash flow, right? So what we're going to talk about is how they get out of it. But the whole thing here is often realtors get a bit intimidated by, oh my God, what's a hard money loan? Just relax. It's just a mortgage loan. It's a first lien mortgage loan, just has different loan terms that come with that mortgage. So, the what is a hard money loan, when to use it, why to use it, who to utilize it. Let's jump in. So you like my fun slide here?
Yes.
So why would someone want or need a hard money loan?
Because the house they're buying doesn't appraise for what they're buying for, or it doesn't appraise for what they need in order to fix the property up and things like that. So they need to borrow more than what the purchase price is.
And so they want to conserve their capital. That would be saving all that money that you see there in the jar. So with private hard money loans, explain that a little bit, how you're able to borrow on the future value of the property to save your money.
Yeah, so if you look at the bottom left corner of that slide, you buy a house that looks like that, you are not going to get full market value for that property. It needs to be fixed. So we need to do a hard money loan in order to anticipate what the property will be worth and the cost of repairs to be able to get that done.
And even a step before that, if they were to buy a house like that, or a house that needs roof work, that needs mechanical, structural work to it, can they go to their bank and get a loan? Can they go to a credit union? Can they call an online lender and get a loan when a house is distressed and not livable?
Very likely not. There are some scenarios, but no.
And so the option of buying it is what? They have to buy it cash, right? Or they have to borrow it from a family member or someone they know. So first reason you're going to use a private hard money loan is because the property doesn't qualify for traditional financing. See, whether it's a Fannie Mae loan, a Freddie Mac loan, FHA conventional, has to be livable, marketable, and safe by their definitions. And the uglier the house, the more opportunity for you, the less likely you're going to get a traditional loan. These investment opportunities that come along, do clients and investors, they typically have 30, 45, and 60 days to close and take advantage of this?
Typically 2 weeks, 3 weeks is typical time frame.
So then with that, you need to close fast. In hard money lending, you can close that in a matter of days. Also, what about clients not qualifying? What if someone just quit their job, might have a poor credit score, but they have a really good deal? Could they get financing with a 500 credit score and just quitting their job with a traditional bank?
Absolutely not.
So hard money loan, could they?
They could. They're just not going to get as good of terms as somebody with a paper.
And all lending is based on risk, right? Someone with a lower credit score is going to get lower terms. Someone with a higher credit score is going to get better terms. So 4 reasons you mainly are going to look for private hard money lending. 1 is the property doesn't qualify. 2 is you don't qualify. 3 is you need to close really, really fast. And 4 is you want to conserve your capital. Now, rather than deep dive into conserving capital, we'll move on because we're going to talk about that as well. Now, the question we get asked typically after, how does hard money work is how much money can I borrow, right? And investors, realtors, you want to know this for 2 ways. As a realtor, when you're identifying a deal that you have, you want to be able to explain to your client, hey, this is the deal. Here are the numbers. This is how much money you'd bring to closing. Because the last thing you want as a realtor is to look at a deal, present it to a client, not know the numbers, and then the numbers not work and you completely get discredited.
Yeah, and then on the flip side to that, if you're listing a property that needs work, it helps to have the conversation about what the house should list for if you understand what the cost is to the person that might be buying it.
And investors they're buying properties for what? For profit, right? So it has to be worthwhile for them to do so. So you always talk about whenever a client calls us and says, hey, I'm looking at buying this property. How much money do I need to bring to closing? How much money can you lend me? We always start off the same thing, right? So why don't you walk them through this formula here as I'm, Brooklyn, what are you doing? You letting people in?
Yeah, sorry. Every time I'm trying to let someone in, it like stop. It clicks.
It's all good. Murphy's Law, right? What will go wrong, will go wrong. So why this catches up and while we're letting others in is imagine you have a pen and paper. What do you want to do with it? You take this over.
You want to make a T in there, and on one side you want to put money I need and money I have.
Perfect. And then what are you doing? What are you doing on those sides?
Can you click back on the slide?
So we're doing that T, and on the left side of that T, what are you writing there?
Money I need.
Perfect. And then on the right side of that T, what are you writing?
Let it get up there. Money I get.
Perfect. So it's always 2 numbers, right? There's money that you need to purchase the property, to renovate the property. There's going to be closing costs, whether you buy cash or with the loan, there's going to be closing costs. And then there's the money that you get from the loan. Right. So when you're looking at, this is money I need to do this project, and this is money I can get for a loan, that leaves us what?
What I have to pay myself.
And bring to closing. So on money I need, what are we writing on that left side?
Got the contract purchase price, how much the rehab is to fix the property up, and what the closing cost is.
Perfect. Now on the right side?
70% of the ARV, that's the after repaired value, what the property will sell for after it's been repaired. And then the total is 70% of that.
Why 70%?
Because things happen. You could have delays in the process. You could have additional repairs that pop up. We want to make sure that we are able to make sure that you make a profit on the deal before.
If they're buying it above 70%, it becomes less and less profitable for them. Now we see investors all the time, they go above 70% because 70% it's a placeholder. Right. But ultimately what you're looking at is money. How much money am I going to make on the deal? And if you're buying deals at 85, 90, 95, 100%, you're just not going to be profitable, right, especially if something comes up that's unexpected with it. So 70% is the formula, and we'll go into how to make an offer after this as a real estate investor. But 70% has been the percentage that's tried and true for real estate investors making offers on properties and hard money lenders lending for decades and decades. If you call around, you'll find lenders that go up to 75%. We're one of them in certain situations. What percentage would you say you want the light to turn orange or as a warning? So green light is anything 70% or less.
Yeah.
Where's your orange light, and then where's your red
I would say orange light's probably 75. Anything above 80, you're probably going to have problems when it gets to closing and you count the chips at the end of the game.
Because if you're, as you'll see, you're buying it at 80%, then you've got carrying costs, right? Then you've got selling costs. Then and those costs eat up to where you don't make a profit. So without us, hammering this in, you really want to pay attention to this and making the offer with it. So we have an example here to go through. Purchase price, Jason, you walk through the numbers as I'm clicking through.
245 purchase price, $75,000 rehab, closing cost of $12,000. So you need $332,000. The after repair value is $450,000, so you can get 70% of that, which is $315,000.
And the difference in the two is your cash to close.
Is $17,000.
Sorry, we've got some.
Yeah, we got some other cameras and stuff. So if you see me going like this, it's because of.
So here's the deal: an investor found for $245,000. It needed $75,000 in renovations. The closing costs, lender fees, title fees, insurance for a year, daily interest, attorneys, all that came up to 12 grand. So the total they needed for this deal is $332,000. Now the after repair value, or the future value of the property, $450,000. 70% of that, $315,000. We have two numbers here. We have money I need, $332,000. Money I can get, $315,000. The difference is $17,000. So someone can purchase this property with $17,000 out of pocket. Now, that renovation money, do they get that at closing?
They do not.
So that money's given in reimbursements as they complete the repairs they said
Right.
they're going to complete. Now, pretend they could have gotten a loan here. They could have gotten a bank.
Yep.
How much money would they have to put down as a down payment for an investment property?
So minimum down payment for investment property is 15%. So you're looking at, what is that, about $38,000 they would have to put down.
So $38,000 down.
Mhm.
Now, do they get that $75,000 renovation money?
They do not.
So it's 30-something thousand plus 75,000. We're well over $110,000 here versus
Plus
17,000
closing costs. So yeah.
plus closing costs versus $17,000 here.
Mhm.
So, why should you as an investor, why should you as a realtor look at private or hard money lending? Well, if we go back a few slides and we have those 4 reasons, one of them was conserving your capital. So you could do one deal if you had the 120,000, or you could do 6 deals like this with 17,000. Let's look at this example again, because twice is always nice. And we'll speed this one. So look, we've got the numbers on this one. Again, it's the same formula every time, right?
Right.
I mean, every deal is pull out a pen and paper, money I need, money I get, walk through this, do the formulas, the difference that you have, cash to closing. That's what you're bringing.
Or
to
you can
closing.
just go to blinklending.com and go to calculators, and we have this on there so you can put those numbers in yourself.
That was a great plug. So again, nice. So if we do minimum down payment is 15%. You said that. The traditional conventional wisdom is it's 20%.
Mhm.
Now, although you can put as little as 15% down, do you recommend that?
No, the closing costs are much higher. It's basically going to cost you about 2% more of the purchase price to borrow 5% more. So you're basically paying 60% of your money for that.
Okay, that was a lot of math, but he's right. And so you have a higher rate, right? You have higher closing costs, and then you have mortgage insurance as well.
Right.
So although you can put as little as 15% down, we've never done it. So 20% is the number we'll use just because it's easier math for us going forward. But at 165, they have to put down 20%, 33,000,
Mm-hmm.
plus the 20,
Yep.
plus the closing. So
Yep.
they're all close to $60,000 as
Right.
opposed to 7,000. Again, big reason, conserve capital. So moving on with this, Brooklyn, will you do some things to where I can?
So,
Nope, it's going. So the next slide that we're going to talk about, and that was a perfect plug by Jason because he mentioned you can go to our website, which is right here, blinklending.com, and get all these calculators that we're talking about, including this one. So the next question that we get asked often is, well, how do I know what offer or how to even make an offer on the property? So we have our hard money offer formula here. Walk us through this.
So that the final sales price of what you would sell the property for after it's repaired times 70%, it minus the renovation cost equals 70% of the offer. Maximum 70% offer. I'm sorry.
So when you say the final sales price, aka the after repair value, how are you getting that? I walk into a house, it's disheveled, it needs to be repaired. Where am I getting my final sales price number from?
You got to run comps.
Okay, what are comps?
Comps are comparable sales that realtors run that have sold within the last preferably 90 days versus 180 days. And the comparables need to have similar trim levels, repairs, size to what you plan on doing to the property, not what it currently has.
So we're looking at the property in its current condition, but we're looking at it to evaluate how much we need to do in repairs
Right.
to get it worth a future value that we're going to sell it for. So we're starting with the end in mind.
Mhm.
It's what could this property, based on the comparables in the area, what could I sell this house for? So we find that, and that's your ARV, after repair value, or your final sales price number, or I guess your list price number would be a better term. And then we're multiplying it by 70%. Why 70%?
Because again, if you have a 70% deal, you're very likely to make profit regardless of what happens with the transaction.
I mean, why are you doing this as a realtor? Why are you doing this as a real estate investor? You're doing this for profit.
Right.
So and in real estate, you make money when you buy. And if you're buying it high, it just doesn't work out. So we want to multiply the 70%. So let's just take an example. Let's say it's $300,000 is going to be our list price.
Okay.
Multiply it by 70%.
210.
So is that my offer?
No.
Okay, what do I need to do now?
You need to consider the repair cost.
So a repair cost, pick a number that we want to use.
30,000.
Okay, so it's 30,000 to repair it. So why wouldn't I just take 210, 70% of 300, 210, and then if I add 30,000 to it,
You're
that's
at
still
240.
240. That's I have $60,000 in equity there though, don't I?
No, because it's
Why
going to
not?
cost you money to sell the property and you're going to have holding costs.
And I'm going to have closing costs for the mortgage.
Correct.
So that $12,000 number, I've got to add that in there. Then while I'm renovating the property, I've got holding costs. What are holding costs?
Holding costs are the property taxes, homeowners insurance, and the interest that you're paying on the loan.
I've got electricity on the house
Yeah,
too,
too.
right? Water. I've got to maintain the yard. I mean, all that stuff, it costs me money. So while I'm holding the property, there's costs associated with it. So often we'll have investors call and say, I'm getting this deal for 240,000, I'm gonna make 60 grand. And we go, wait a minute. That doesn't work out. Because again, you have to add your costs, your carrying costs to it, your selling costs to the property. That's why you want to buy it at 70% or as close to 70% as you can. Jason's red light is 80%. My red light's 80% too. In rare cases, sometimes we run the red light, but there's got to be a real good reason for that. So again, these are intended to be your buoys here, right? You've got a green light under 70%, 70 to 80%. We've got a yellow light, and then anything above that is red with maybe rerunning. So now,
And I would advise that the more that the repairs are, you want to be more cautious at that light. So if there's more repairs to be done on the property, you want to make sure that number stays closer to 70%.
absolutely. Why?
Because one, you can't really budget for how long, what the repairs are, and two, the larger there are repairs, you have contractors that could flake out. You have a time frame that could eat into your holding cost.
Yeah, I finished on time and on budget, said no real estate investor ever, right? The budget that's a whole separate conversation. So I took my 300, I multiplied by 70%, I got 10. What am I doing with that 30,000?
Deducting from the 210.
And now I get what?
180.
And what's that number?
That's the offer.
That's the offer number. Let's work through this. So we're going to go through this formula again. Final sales price, 400,000.
280.
70,000 in cost.
210.
210. Now, does that mean if you offer 220, 225, it's a horrible deal?
I mean, it just really depends on what the $70,000 is. You know, if you're having to gut walls, replace electricity, there's foundation issues, there's a lot of things that can happen during the rehab that $70,000 can be $90,000. So it just really depends on the deal, but you know, it doesn't necessarily mean it's horrible to buy it in 220.
Yeah, the takeaway here is that is again, these are buoys. These are set in place to have you, if you run your numbers and you see it's 95%, don't bother driving out to the property. Don't bother calling a contractor. It's just not a good deal. So moving on, a question we get asked again is, well, what's my payment going to be? Because big shockers, investors have big sticker shock when it comes to private or hard money interest rates. They hear 10, 11, 12%, and they get scared. And often it's not about what it costs you, but what it makes you. So walk us through how to calculate your payment.
So you got your loan amount times the interest rate divided by 12 is your monthly payment.
So loan amount times interest rate divided by 12 monthly payment. So we have an example here, $320,000 loan times 10.99% interest. We divide it by 12. We get $29.31 per month. Now, is that the exact accurate way of doing it to where we get that payment every single time, every month?
Well, no.
Why not?
Because if you get a loan for $320,000 and there's a $50,000 rehab budget, your current loan balance is $270, not $320. So you'll have a lower payment to start.
Lower payments, where Jason just went there is you shouldn't pay interest on your undrawn rehab budget. So your renovations, if you go back to the slide that we had $75,000, that money is not given to you up front at closing. Rather, it's put in an escrow account. You receive it in reimbursements. So your payment is going to change each month if you work with a company that doesn't charge you interest on your undrawn rehab budget. There's a lot of companies out there, the majority charge you on the full amount, right? Where I thought you were going to go with it is based on the number of days in the month.
Oh God.
So, we're firm believers in that you should pay daily interest, meaning pay interest for the exact amount of days that you borrow the money. And some days have 30 days, others 31. So the exact way of calculating your payment is to take your loan amount times the interest rate, divide that by 365 days, round that number to the second decimal, and then multiply it by the number of days in a month. That was a whole bunch. What's the easiest way they can do it? 1% per month.
Oh, that's the absolute easiest. Yeah, for sure.
So let's just park here for a moment and we'll take off. Your private hard money payment, that 12% is only 12% of what?
Your loan balance.
If you keep it to also for the full year, right?
Yeah.
So when you pay 12% interest for the year, best way to calculate it is take the interest rate, divide it by 12 months, and then whatever rate you have, multiply that by your loan amount, right? So if we take 1%, because average rate out there is 12%, take 1% per month, whatever your loan balance is you multiply by 1%.
Right.
And so if a project takes you 4 months to complete, how much are you going to pay in interest? 4%. So when you hear 12%, you hear 13%, 11%, as an investor, is it smart to just say, that's too expensive and run away?
No.
Instead, run the numbers and see how long are you going to keep this property for. And unless you keep it for the full year, you're not paying 12 months of carrying costs or 12% interest. That's that website. We have this calculator on the website too, don't we?
We do.
We have a lot of calculators on the website. Calculators on how much you get pre-approved for, calculators on fix and flips,
Yeah.
that service coverage ratio calculators. What other ones? I mean, you've done them all.
We have a HUD that you can do online, so you can literally put in your respective deal and get your cash flows for it.
There's a few things that can be disappointing for a real estate investor. One of them, the most, is the numbers changing or expecting to bring 5 and the number's 15. I mean, that can just be gut wrenching.
For sure.
So on our website, we have a preliminary HUD to where an investor can walk on without talking to us. Just go on the website. It says calculators, top toolbar. Click preliminary HUD. You can just plug in the numbers to your deal, and you have the formulas in there to where it calculates title fees, insurance fees, lender fees, attorney fees. I mean, that thing gets pretty close to the number. All right, marketing. How are we marketing for these deals? What are we looking for? That about cover it?
That about covers it.
So can you, to do a fix and flip, am I finding a brand new house?
No.
Why not?
Because there's no trapped equity in the property. There's no way for you to improve the property and make more money off of it.
Because that's what's being done here, right? So we're buying properties at a low price because they have deferred maintenance. They need to be brought up to market conditions. And once they're brought up to market conditions, since we're the ones that did that, we're going to be the ones that make the profit for it. So, as a realtor, you're driving around town, you're showing buyers houses, you're going on listing appointments. And as you're going by those houses, you're seeing there's a house that has tall grass. There's a house that has deferred maintenance. There's a house that, has mail and newspapers that are piling outside of it. Those are good leads. What do you recommend realtors do when they see those houses and just very clearly see the address and the street name right there?
They can do a lot of things. They could go knock on the door if they wanted to. They could go look up the information about who owns the property, the last time it was listed. Realtors have a lot of tools that they can use through HAR and through tax services. And
there's skip trace and tons of other information too, right? But that's called driving for dollars, and we'll jump into that here in just a moment. But while you're out and you're going from property to property, why not create a property list? That if you don't want to go knock on the door right then and there, which that's where we've seen our investor clients have the most success.
Absolutely.
Send them a letter, call them, follow up with them later. There's apps now, and I don't know what they're called, but you can just take a picture of the house and it just gives you all the information stored in there, and then you can follow up later. But you're looking for properties that are distressed. What I mean by distressed is either structurally or mechanically, these properties, they need to be repaired. So anything more than $5,000 can be challenging to get a conventional or FHA appraisal on. Where can you find these deals?
Social media is a huge place that's been growing up a lot. Like you said, driving for dollars, wholesale websites.
What's a wholesale website?
A wholesaler is somebody who buys a property or gets a property under contract with the intention of selling that contract. And they list their properties on websites with their price that they would accept for buying out the contract.
So they're selling the contract, right? Instead of buying
Yeah.
the house, they sell the contract.
Right.
You mentioned Facebook and online. The amount of clients that we have that find deals online, it grows more and more and more. At first, you wouldn't think, why would I go on Facebook to look for a property? But if you're selling a property, if you're a wholesaler, you're an investor or a seller, and you want to get rid of a property, you want to sell the property. And if there's investors that are hanging out on Facebook, why wouldn't you list the property there? So online, whether it's social media, whether it's HAR, MLS, Zillow, all the other, I mean, you guys know and gals know the platforms better than we do. But often investors say that you can't find deals online. And that's just false.
Right.
That's all you have, just right. Not gonna lead me at all.
No, I'm sorry.
Just great. That was good. All right, where else can you find them? Investors, do they sell properties?
They do.
Okay, investors buy properties, they sell properties. Wholesalers, we talked about driving for dollars, probate attorneys, divorce attorneys, bankruptcy attorneys. What about neighbors?
Oh yeah, for sure. If you buy a house that's distressed, go introduce yourself to every single neighbor on the block.
We have a client, Alberto. He is the best at this. Every time we do a loan for him, we know that pretty soon we're going to be doing a loan for one of the neighboring properties. Because he goes and he says, hey, that ugly house that's on the corner, I'm buying that. I'm going to fix it up. During the next few months, I might have some trucks coming by here. We'll be very respectful, we'll be very polite. Here's my phone number. If there's ever any issues, I want you to call me directly. And by the way, if you know anyone in the area who's looking at selling a house, I'll be over there. I'd love to take a look at it. And then before it's all said and done, hey, Alberto, because they've seen him now for 1 month, 2 months, 3 months. Hey, Susie wants to sell her house. And he ends up buying Susie or Freddie or Tommy or whoever's house. Friends, colleagues, look, you want to, in sales, which is what we're all in, you want to make more money, you have more conversations. It's just that simple. So you want to tell as many people as you can, this is what I do, right? You never know where it comes from.
Yeah, and as a realtor, you'll have some colleagues complain about this listing. They just can't sell, that there's something wrong with the property and they can't sell it. It's a perfect opportunity for you to get an investor in contact with them.
Right. So we're going to do a case study here because facts tell, stories sell. Let's go over some stats here on a deal that we had. Purchase price $335,000, renovation budget $85,000. Client after repair value was $620. Our after repair value was $595. The loan that we ended up giving was a 6-month loan term. It closed back in August of 24. It sold in February of 25, so a little less than 6 months, to a cash buyer at $617,500. And going through it, this is what the house looked like before they bought the property. Not too bad, huh?
No, not bad at all.
And just pausing on this, and we'll see the after photos, of course. But how many times do you walk up to a house and you see a house look like this?
I mean, it doesn't look terrible. Like
It's
there's
not.
nothing wrong with it.
No, so a lot of times realtors, investors think that these home runs are hit on deals like that slide picture we show of the house, leaning over. But often the best opportunities can be gotten on a house that's just been lived in and loved in for 20, 30, 40 years. Maybe it hasn't been updated. It's been kept as a rental property, or it was one couple that was living in there for however many years. And you go in and it's a clean looking house, but we've got some bushes that are overgrown here. I mean, that's easy work. We do some painting, we clean it up, we change out the kitchen, as we'll see, and you can create the opportunity to, well, make the bucks. So it's this formula every time, right?
It is.
Purchase $335, rehab, closing 85, 18. Why are the closing costs 18,000 versus 12,000 on the other slides?
It's a bigger loan amount.
Bigger loan amount. So title fees are based on loan amounts, lender fees are based on loan amounts, insurance costs are based, it's higher loan amount, higher cost. 70%, 595. Why do we use our number? Why didn't we take the client 620? You can tell them the real reason.
Because we're conservative. We don't want to lose money on the deal.
Yeah, it's our money. So lenders will always do it. We're no different than anyone else. The only difference is we say, hey, we're like that. And this is why. When you have two numbers, you're going to take the best case scenario. And if best case scenario for lender, and this is conventional lending, FHA, private hard money lending, it's always been that way. Banks, and it'll likely always be that way. So 595 is the number that we took. 416 is the after was 70%. So they needed 438. They got 416. How much money did they have to bring to closing?
They had to bring $22,000 to close it.
Again, if they would have, if they can get a loan for this, they're having to put down 20% minimum. 20% on 335?
$67,000.
$67,000 plus 85,000?
$152,000.
Plus 18,000?
$170,000.
It's $170,000 out of pocket versus $22,000 out of pocket. How many deals could you do? It's like 7, 8 deals we can do. On that, what if they do have enough money to buy it cash? Is that a bad idea?
It just depends.
That's always the lending answer. It depends. Look, it's your money. If you'd rather buy it cash, buy it cash. Borrow half. You don't have to borrow the full 70%. We've had investors every now and then, do I have to borrow the full 70%? No, you don't. Maybe this client right here had $80,000 allotted, and they say, I have $80,000 to put down this deal, which a lot of investors will say, we just lowered the loan amount. The lower the loan amount, less fees, more profit, works out.
Less risk, so you might get better terms.
We love less risk. So client took 2 draws during the rehab process. They took the first draw at $68,000. They took the second draw at $17,000. Again, you can, as a real estate investor, you don't get the rehab money up front. You get it in reimbursements as you complete the work. So they said, we have $85,000 worth of renovations we need to do. They did 68 and then asked for the money. Did they have to do $68,000?
No.
How much could they have done before they asked for money?
$15,000.
15,000 is typically the minimum. Now you'll find private hard money lenders that don't have minimums. You'll find some that have higher, but typically 15,000 tends to be the amount. Second draw they took just a month later. They forfeited the remaining balance. We'll skip this slide right here just to go in and see how pretty the house looks. Look at that. Looks great, doesn't it?
It does.
Does that look overwhelming to anybody on that's with us? They redid the kitchen. They redid a bathroom. They did flooring. They painted the house. They staged it, which staging is so key. That's a whole other webinar we could do. So going over the final numbers, again, the purchase price was $335,000. The closing cost was $18,000. The loan balance at closing, because they brought money to closing, holding costs, property taxes. I mean, we could walk through all these in depth, but ultimately what we want to see is this. We want to see how much cash did they get at closing? What was their total investment, meaning holding costs, cash to closing, everything, total revenue generated on the deal, the profit that they received, and the cash on cash return. I mean, in a 6-month period, they made $70,000. Now, sometimes it doesn't go that way. Sometimes you make less, sometimes you make more. But if they had bought this deal at 80%, if they had bought this deal at 85%, 90%, these numbers aren't going to look this way.
They would get a third of the profits at 80.
That's a whole bunch of cash on cash return. All right, why do we have credit scores up here? Why is this so important, Jason?
Because we lend based off of risk. And if you don't have a good history of paying other people back, we don't feel like you have a good history of paying us back.
And that's just all lenders. So lenders want to know, are you going to do what you said you're going to do? And the higher your credit score, the higher your likelihood of doing what you said you're going to do. See, our credit score at its core is our numerical representation of our ability to do what we said we're going to do. So when you say, you the investor say, I'm going to pay you back, well, do you have a history of paying back? So that's that on the credit score. And the higher the score, the lower the risk. The lower the risk,
the better the terms.
The better the terms. And in real estate, you make money when?
You buy.
When you buy. And if you have financing that's tied to your acquisition price, what does that mean if you have a good deal, but you get bad financing with it?
don't make as much money.
That deal can turn bad. You're not going to make as much money. Now, if you have a good deal and get good financing with it, that's what you want to do every single time, right? So we'll have clients, they reach out and go, Paul, I want to invest in real estate. What should I do? I go, what's your credit score? They say I'm at a 742. I say, great, let's get it above a 780. They go, huh? That's not what I was expecting to hear from you. I get it. But right now you don't have a property. So the next thing I'll tell you to do is go find a property. It's not build your LLC. It's not get your business cards. It's not get your team. It's not do your website. It's go find a property. Now, as you're searching for a property until you have one, increase your credit score. Because when you do find that property to buy and you are going to get financing, if you have a lower credit score, you're going to pay more. And when you pay more, you make less. So credit score is very important to all of us lenders. It's first base. And without a good credit score, you're already handicapping yourself. And there's ways that you can increase your credit score. We'll go over that at a different time. And it's not as complicated as you think. We have those ways on our website. Again, our website's amazing. Say it's the best website, best mortgage website in the universe. Like that includes the big guys that have stadiums named after them. Knowing your financing options, really fine, right?
Yes.
Walk them through us.
Conventional financing, that's your conventional loans and your government loans, FHA, VA, things like that.
What does non-QM mean?
Non-QM is qualified mortgage. So it's basically just none of those conventional financing, but still long-term financing, portfolio financing.
So conventional financing is where we're getting the money for that?
From either Fannie Mae, Freddie Mac, or the government.
Fannie Mae, Freddie Mac, or the government. Non-QM, where are we getting that money from?
It's banks.
Banks, hedge funds, insurance funds, lines of credits. It's institutional funds. So with one, we have, let's just call it the government making up rules. The other is we have private sector making up rules. 3, commercial lending.
That's if you want to buy a property that's not a 1 to 4 unit residence.
And you can get commercial loans, local community banks. There's regional banks. There's Scotsman's Guide for a larger national projects. Private and hard money lending.
Us.
That's us. Especially state of Texas. That's us. Now there's others out there. Difference from us and them is we're cheaper, faster, and easier to work with, and we can show you how. And then what's up with these bank statements, CPA and LOC loans?
Self-employed clients. So clients that don't have traditional income, sometimes they need to use other ways to prove that they have income to be able to pay back the loan.
Yeah, we're really, really, really good at those loans. In 2025, we're getting close to 2026. You know, all lenders should be really good at conventional loans right now. All lenders should be really good at FHA loans because they're simple. But not every client fits that box, right? We have business owners, we have contractors, we have self-employed home buyers, buyers who have recently switched over from this employment to that employment, and we offer those loans. Really, really good at them, and they're important because for real estate investors, you're likely not always going to fit the traditional box. And when you don't fit that traditional box, well, there's plenty of other boxes we can put you in is the short version. But those are the financing options that you want to be aware of that are available to you and that are available to your clients. All right, so conventional loan, these loans are based on what?
Personal income.
Personal income. So conventional loan, when I go to obtain that loan, what do I have to provide to get that loan?
Your government tax documents.
Pay stubs, W-2s. I have to prove my personal income, right? Now, when it comes to debt service coverage ratio loans, what are those loans based on?
They're based off of the rent that the property receives versus what the total cost is for the property.
So big distinction here. Difference between conventional loans and debt service coverage ratio loans is simply this. Conventional loans are approved based on your personal income. You're proving your personal income. You're showing tax returns. You're showing bank statements. You're showing pay stubs or 1099s, whatever the case might be. When it comes to debt service coverage ratio loans, it's the lease agreement of the property. What is the income that the property is producing, and that income is going to be used for loan qualifying purposes. Now, does the property have to be leased when you're getting a debt service coverage ratio loan?
Not even when you're refinancing it. So purchase and refinance, you don't have to have a lease to be able to do it.
So a lot of times we'll have investors, they think the property needs to be leased out prior to moving forward with the refinance. So you're in a hard money loan, you're paying 10, 11, 12% interest, and you got the property leased out, you just haven't gotten the right tenant yet. Well, you think you can't start the refinance process until you have a tenant moved in, until you get the deposit, until you get all that. But that's not the case. What can I utilize instead of the actual rent agreement?
So there's a document that's included in an appraisal for investment properties called a comparable rental analysis. So it's basically just an add-on to the
Get
appraisal.
fancy, give them the number.
So it's called a 1007. So a normal appraisal is a 1004, and this would be a 1007.
Awesome. So they go on that report, find the rental income.
Yep.
And utilize that, and that's how the loan's approved.
It is.
Very simple. All right, so how does a debt service coverage ratio formula work? Well, you want to take the rents. Back here, we showed it to you. Now we're going to move on and do an example. We take the rents. How are we doing on time, by the way?
We got
21 minutes.
We're crushing. This is great. Okay, so debt service coverage ratio, we're going to take the net operating income. We're going to divide it by the expenses, and that's going to give us a ratio. This formula, it's great for debt service coverage ratio loans, but it's also great to determine whether or not this property is a good rental property, right? So how do we do that?
Take the principal and interest, property taxes, the homeowner's insurance, and the association fees.
That's just a fancy way of saying PITIA, because you want to check and see if there's a homeowner's association, right? So we take the rents, we're getting $23.50 here. And then the total that this house is costing us is $18.39. I know you can't see it, so I'm running through the numbers. So $23.50 is what we're getting in rents. It's costing us $18.39. So what we're going to do is we're going to take $23.50, the net operating income, and we're going to divide it by the debt service, which is $18.39, and that gives us our debt service coverage ratio of 1.28. Is that a good deal?
Amazing.
It's an amazing deal. I mean, we're making $500 cash flow, plus we have a high debt service coverage ratio. What if my debt service coverage ratio is below 1%? What does that tell me?
You are having negative cash flow.
Yeah, if it's less than 1, you're not cash flow. What's cash flow?
Cash flow means you're bringing in more money than you're paying per month.
The difference in what I'm paying and bringing in is a cash flow. So that, as a real estate investor, I do this for cash flow. There's a great game called cash flow. So this is a 1.28 ratio. If it's under 1, again, you're not cash flowing. You want to look at, why am I buying this property if it's less than 1%? Why let me go back here so I don't lose everybody on these numbers. Is it bad to buy properties that aren't cash flowing?
Depends.
It's always the answer.
If the property's appreciating and if it's really appreciating, or you plan on doing something extra to the property, like let's say you buy a big piece of land with one house on it. That one house might not cash flow, but you could subdivide the land, sell the land off. You could build other houses on it. So it just really depends on what your plans are for the property.
So that is definitely an option, right? You can add structures to it. What if I can't? And what if I'm losing $300 a month, but the property is worth $500,000 and it appreciates 3% a year? $300 a month. $3,600 a year. That's what it's costing me. Do I get tax write-offs with that money?
You do.
And it appreciates 3% a year at $500,000. It's $15,000.
And you don't pay taxes on that money.
And I don't pay tax on that money. And my net worth now increased by $11,400 in this example. So don't look at a property, if it's not cash flowing, automatically dismiss it, because it depends. It depends. So we'll look at this debt service coverage ratio here, because again, twice as nice. Net operating income, $1,500. Debt service, $1,378. Debt service coverage ratio, 1.09%. Not as sweet as 1.28. We're cash flowing, right?
Fair deal.
Fair deal. Now, when we're cash flowing, do we also still get to take advantage of the appreciation?
You do.
So that's great. So you might look at this and go, hey, I'm only making $122 a month here. It's not worth it. Well, what's the appreciation? And then where are you going to be in 5 years having somebody else make the payment on your mortgage? Where does that leave you as far as profit goes down the road? So when it comes to personal income loans, we're looking at the bank statements. We're looking at W-2s. We're looking at tax returns. Questions for these loans, where can they go get answers?
Our website.
How many FAQs? We have over 200. Do you know that? Over 200 FAQs on the website. He does the calculators. I do the FAQs. How to determine whether a deal is good or not. So fix and flip. Just put some quick rules of thumb here. Less than 75%. Look at it. We talked about 80. Starting out, I'd be more conservative with the number because the numbers don't change. Don't make this mistake thinking that the rehab is going to change, right? I want to buy this property. I know the contract is telling me 50, but I'm going to get it done for 35. You're not. You're just not. The actual amount of profit as a dollar figure, we've just told them to not buy a deal over 80%, right?
Mhm.
So if they buy a house at 50,000 and needs 20,000 in renovation and they can sell it for 100, that's a 70% deal. $30,000 right there, right? Forget
Right.
all the cost of it.
Mhm.
So now that it just forget the cost. You're making $30,000 in this example. Now they go find a property for 140,000. It needs 20,000 in rehab, and it's worth 200,
It's an 80% deal.
and they're making 40,000.
Mm-hmm.
So what's better, to do one at 70% make 30,000, or to do it at 80 and make 40,000?
I'll take the first one.
I'll take the 40,000. Now, here's the thing. Doesn't matter. It's just that's what fits him, and that's what fits me with mine. But you want to look at the percentages, and then you also want to look at the dollar amounts that you have with there as well. Buy and hold, we have less than 90% ARV. We don't have time for that, but there are clients that'll, when they're buying a property to keep it as a rental, they will break that 80% rule and go up to 90%. Why?
Because it cash flows.
It just depends, right? I don't want to go above this
So you're
number.
looking for the depends that time.
Well, it's just there. That's just all lending. There's another joke there. Talk to me about the 1% rule.
So the 1% rule is you want the monthly rent to be at least 1% of the purchase price of the house.
So I'm buying a house for $250,000. How much do I want the rents to be?
1% of $250,000, $2,500.
Then look, this is likely just a real good deal. Just full speed ahead. That light's green and it's not turning yellow for a long time when you find that deal. Now, how often are you buying a $500,000 house as an investment property and getting $5,000 a month in rent?
Never as a long-term rental.
So as the number goes up, that 1% likely gets less and less and less. Does the 1% rule mean that if you're not making 1% to not buy the property?
No.
Why?
It depends.
It depends. All right, ground up construction. This is big, and you realtors know this. Not all land is created equal. If I have 1 acre that's going this way, or if I have 1 acre that's going this way, or if I have, the other way, you get where I'm going with this, right? A lot of different ways there. Not all land is created equal. And also, what's the highest and best use for the land? And then what's the permitting that's going to come with the land? We have clients that subdivide land. Some of them have been really successful. Others have been not as successful because surprises come up. So you always want to look at that. Anything you want to add to land before we move on?
No.
Knowledge is power, see or no? That means yes or no.
Not 100%.
Not 100%. We need to apply the knowledge,
Yeah.
right? But if you want knowledge, go to where?
BlakeLending.com.
Our website. We've got tons and tons and tons of information. What makes us different than other lenders when it comes to interest rates, loan costs, speed, process, etc.?
So we offer wholesale interest rates. So if you're going to a bank, they have to pay for the stadium that you were talking about earlier. And so we don't have any of those overhead costs. We are very fast, direct. You don't have to talk to 5 different people in order to find out about your loan. And our rates are lower.
Is wholesale lower or more expensive than retail?
Is Costco more expensive than going to Whole Foods?
No. Do I sacrifice product when I go to Costco versus Whole Food? Costco's awesome.
Yeah, Costco is awesome.
So think of us as Costco. You walk in and the store's amazing, super clean, very friendly people, all the products that you need. So whenever it comes to loan products, whether it's for people for a home to live in, a purchase, a refinance, a cash out, an investment property, a hard money loan, a debt service coverage ratio loan, a bank statement loan, not only do we offer those products, because there are a lot of lenders that offer those products. The difference is we're really good at them. We have experience at them. Like we know that other lenders offer bank statement programs, but ask them, when was the last time they did one? They don't. They offer debt service coverage ratio loans, but when was the last time they did them? And just because you do one thing once, it doesn't mean you're any good at it. So BlakeLending.com, utilize it for any information. We have something that some realtors love, other realtors hate. And what that is our instant pre-approval letter. This whole idea that the lender has to pull your credit, get your documents, spend days to get a client pre-approved is just not the case. We can ask them a few questions, and within a minute, we can get them a pre-approval letter. What other mortgage companies have this?
None.
None. It's right here, Houston, Texas. So if you have a client on the weekend, they want to put an offer in on a property, whether this is for a home to live in or whether it's an investment property, it's you want to put an offer on a house, but you need a pre-approval letter. Go to our website. No applications, no credit checks, no documents. We ask you questions. Based on the answers to the questions, you get a pre-approval letter. And then if you want to go do the loan with your brother-in-law or another mortgage company or stick with the same lender, that's fine. But what's not okay is missing out on the deal because your loan officer was on vacation or was, which they should be able to take, or was sick or was at their kid's soccer game, right?
Right.
Want to close this out with anything? Because we wrap this up in 8 minutes to spare.
Awesome. That's great. We definitely have more webinars to come, so please stay tuned.
Sweet. Costco. All right, awesome. You guys were great. Again, my name's Paul. This is Jason. It's like P&J. Y'all have a great Wednesday. Cheers.